and welcome to the second Industry Outlook webinar of the year. And we're focused on the hot topic of a spotlight on supply. Um, I'm sure many of you are still joining, so we'll start slowly and hopefully you all get in and can see the screen. If there are any technical issues at all, we do recommend that you're using the latest versions of either Google Chrome or Firefox. Hopin tends to work better on those platforms. We also did have an awful lot of registrations for this webinar this morning. So it's been one of our most popular ones at over 500. So anybody having any issues, maybe with the screen blurring just at the beginning, that does tend to happen with Hopin as many people are joining. So just bear with us, it will kind of right itself. The other thing to mention this morning, questions, we'd welcome questions. We do have a really tight schedule. We've got a lot of really good presentations to get through and some excellent speakers and panelists, but we will try and answer your questions as much as we can through the hour session that we've got. If we don't manage to answer all of the questions, we will try and take those away and get answers and feed those back. The webinar is being recorded, so if you do have any technical problems or have to drop out for any reason, it'll be available on the BVRLA website after the event. And then if we can just move on to the competition law slide, really important that we cover this off. As a trade association, obviously we need to make sure that we are compliant, and that if you are asking questions or making comments in the chat, please just take a second to look at this slide, which includes our competition law do's and don'ts. So all of our meetings, webinars, any event that we have, subject to the application of competition law, and therefore must be conducted in compliance with competition law. Attendees are reminded that failure to comply with competition law may bring with it serious consequences for individuals and companies, and these include heavy fines. So the really important one to look at is do not discuss individual company prices, price change, terms of sale. The other one that may come up today, information as to future plans of individual companies, production, distribution, marketing plans, anything like that, and anything that is commercially sensitive. So please do avoid any of those comments this morning. That would be much appreciated. And without further ado, then we'll move into the first section, as I've got 4 minutes, I believe, to talk about a survey that we conducted in March, our business impact survey. We had really good response rate to this business impact survey. If you contributed, thank you very much. We fully appreciate it. We had over 80 respondents and a real split between our different member companies. So we had 18 leasing companies, 25 rental companies, and around 28 leasing brokers respond. And some of the top line headlines you can see there on that slide. That sum that you can see is supposed to kind of be one that's sort of doing, sorry, I can't see what you can see, sort of in the middle. I think the overall impression was the outlook is cautiously positive, but supply issues are creating a very challenging environment. And I think you can see we asked the question, what do you think is going to happen over the next 6 months? How do you think your business is the economy going to improve? But only 15% of people think the economy is going to improve over the next 6 months. But 54% do expect to see growth in fleet size, so that's fairly positive. And 41% expect the rental sector to improve. So again, slightly down on what we saw in the survey results in October, but still reasonably positive. However, the other side of that is the leasing industry, whereas we had 38% of respondents expecting the leasing sector to improve, only 24% are expecting improvement over the next 6 months. And then on the sales transaction side, 45% of respondents saw better sales transactions, whether that be more leases sold or more rental transactions than in Q1 2021. But it's worth obviously bearing in mind in Q1 2021 we were in a form of lockdown, not obviously as severe as the first one in 2020, but there was a lockdown. But sales transactions were still going on, although rental would have been significantly down. And then again, another more positive one, 94% expecting staff levels to remain the same or increase over the next 12 months. But as you would expect, 94% of respondents to the survey said that supply is a primary concern. And you'll see as we go on to the next slide that that is really across all sectors, across all vehicle types. So hopefully you can see that on your screen now. This is the second slide, showing that vehicle supply challenges persist. Really, if you look at the one on the right hand side first, the average time it takes from ordering the vehicle to time of delivery, 7 to 12 months is the norm, which I'm sure you're all experiencing. But quite a lot of those, particularly if you look at the HGV, the vans, more than, that's well over 50% are saying 10 months plus. So supply issues really are a challenge at the moment, which I'm sure you're all experiencing. And then we ask the question of how much of a barrier is the supply of vehicles to your business? And again, quite a few of those, particularly ICE cars, BEV cars a little bit lower than that, but still a huge issue in terms of being able to run your business as you would expect to do. And then just moving on to the last slide, so the business impact survey top line results, we've put a few of the verbatim comments that we received on there as well. And I think the thing that really stood out for me from these is that we're spending an awful lot of time at the moment talking about flexible working and agile working, and actually that's coming through in terms of what people are expecting from their vehicle suppliers as well, whether they want a vehicle for an hour from a car club or for a month from a subscription service or from a rental company. They're looking at agile solutions to mobility at the moment. So that's really that came through quite a lot from some of the verbatim comments that we had. We're seeing more and more customers consuming all of the services we offer, said one member. So there's real, as I say, as we're seeing in our work environment, whether we're sat in our homes this morning or in our offices, flexibility and agility are key to vehicle supply. And this, you can see we've also put a graph there about the change in the demand for mobility services. So certainly van flexi rent much stronger, salary sacrifice as well with the growth there, and PCH not as much, but again that's probably closely linked to obviously all the supply challenges. Which brings us nicely onto the poll question, which you should be able to see on the right hand side of your screen. If you could answer that, it'd be great. How badly are the current supply shortages impacting your business? Are they apocalyptic, terrible, tough, easier for other people to say than me, dealt with, or beneficial? If you can answer that, and we'll look at the results of that in a bit. So as I said, we're a little bit tight on time, so I'm going to hand straight over to Ben Waller, who is Associate Director at ICDP. For those of you not familiar, they're an international research and consulting organisation specialising in automotive retailing and after sales. So Ben, welcome. And Ben's going to just give us a quick 10-minute presentation covering the general situation, what's driving it, etc. So I will hand over to you, Ben.
Thank you, Amanda. Good morning. Well, thank you for asking me to talk about supply today. Just one comment I'd like to make is that in supplies, so I think supply is a little bit like plumbing in your house. I think it's all fine and no one really focuses on it until it all goes horribly wrong, and then people want it fixed and attention moves to it very quickly. So chip shortages, yes, we're all aware of the situation. The shortages arrived in 2021. The long lead times you've just been talking about and low stocks are challenging for everyone in the sector. But of course, this comes on top of a long list of previous disruptions, WLTP and the impacts that had on launches and quite a few models in terms of supply availability. Then for UK came Brexit, COVID. It's easy to forget, but we had the plant closures. We had massive overstocking when the dealerships were closed across Europe for most markets. And when plants did resume, they were with some limitations on capacity due to social distancing. And since then, we've had other inflationary pressures as the markets have come back. And even before this year, there were thoughts that there will be constraints on, for example, batteries for electric vehicles in 2022. And then, of course, we've got the war, the Russian invasion, the unjustified and brutal war on Ukraine has disrupted assembly, components and materials, and added to the already soaring inflation that threatens to hit underlying demand. Volkswagen plant in Zwickau that produces many of the electric models, including the ID3, the ID4, was impacted early on, and Volkswagen have delayed the launch of the ID5. This is all public domain information, I should add, just to be clear, given the points earlier. Leone, the wiring harness supplier, have continued production, although moving most of their production out of Ukraine. Nokian Tyres have moved a lot of their production out of Ukraine as well. Auto Logistica, major logistics provider across Eastern Europe, based in Ukraine, well, a lot of their drivers have actually gone to fight in the war. So the impacts are quite direct and immediate. However, there are other medium to long-term effects. Stellantis were going to, again, public domain information, we're going to move a lot of their supply of LCVs assembled in Russia, redirect that towards Europe to meet LCV demand. They've cancelled that decision and paused production. Ford Solars paused production, but it's also worth saying that many manufacturers were already withdrawing and bringing down their plans for the Russian market, both production and sales, due to the weakening market there, partly as a result of the sanctions from 2014. Renault is highly exposed with their 2/3 share of AutoVAZ, and also they sell under the Dacia brand there. And they resumed production early last week. That prompted a backlash, and alongside that, investment analysts weren't happy, and Renault had reversed that decision and are looking to withdraw from the Russian market. There are longer-term impacts. Material supply, just one example with Neon, a good proportion, the exact percentages are disputed, but between 25 and 70% of Neon production comes from Ukraine. That's needed to make computer chips, basically a component within the lasers in production of computer chips. And so that may impact upon the chip shortages even more acutely over the next year to 2 years. And more broadly, of course, the inflationary effects of gas, oil, and wider, say, food prices do threaten to, as the news item from Bloomberg points out, at best delay the world's economic recovery from COVID. So fairly major and significant impact looking ahead. Of course, it's worth putting this in perspective, given what's happening in terms of human suffering. We just have to hope for the best for Ukraine, the people that are there or have had to flee already. And our thoughts are with the people there and the people who have had to leave. But looking ahead, what are the prospects for recovery? Well, car makers have been competing with other sectors for chip supply. As the chart above shows, in terms of market capitalization, the chip suppliers are actually in quite a powerful position, and the assemblers are quite distant to the car makers. And secondly, car makers are actually in a queue and not at the front of that queue in terms of global spending by sector, well behind PCs and smartphones. And the good news is that constrained supply has boosted profits for manufacturers and dealers, and the need for discounts has basically evaporated. Some quotes on the left from newspapers around dealer groups and manufacturers' announcements, and on the right from Lagos in France. And I'm sure this is public domain information. They cancelled a lot of their fleet deals to the end of last year, in terms of the discounting deals to rental fleets and so on. So, and I'm sure you all are very aware of this. The key point is that manufacturers are actually rediscovering the value of an efficiently run supply system from a point of discipline, of making sure that there is real customers behind orders. And it's not just on the new car side. The quote on the top right, the rise in residual values, 30% plus for cars, up to 70% on LCVs over the last year, has meant that defleeting has been quite profitable for manufacturers, and I'm sure lots of other companies as well. This actually aligns and gives manufacturers an opportunity to to move ahead more clearly with what they're trying to achieve in terms of their long-term objectives, and that is to get closer to the customer. You may have heard a lot about omnichannel. I'm sure you heard a lot about it in terms of manufacturers' objectives, and it is top of their list. Why? Because they want customers to engage with them more directly. They're aware that customers, and we see it in ICP research, customers do want to engage seamlessly online and offline. They don't want to either sell to buy online or offline, and those to be separate processes. They expect a seamless interaction, as they do in many other retail channels. And that is fundamentally incompatible with the stop push model. To let customers drive orders, to let them drive the process, and for those same cars to be available and visible online and offline, the same display, the same availability to retail customers only happens if you have shared inventories and a shared pipeline. Whether it's franchise or agents, which I'll come on to in a moment briefly, it's no good having the offering if all the stock is locked down in dealerships. And manufacturers also looking to become more responsive to avoid oversupply, from moving from a fixed push schedule set months ahead to a more fluid and dynamic response. An omnichannel requires this better matching of supply with demand, regardless of the network format chosen, and puts new responsibilities on the manufacturer. The established players must overcome their legacy systems, their dealer network issues, legacy issues and behaviors, whether they move to a modified franchise where stock is shared and owned and ordered by the dealer, a genuine agency model such as Mercedes-Benz has in Sweden, or a direct sales model, the most obvious being Tesla, which are opening more physical sites but fully owned. And the new entrants must overcome maybe the lack of expertise, as the manufacturer quote, the lack of decades of engineering and process expertise. But of course, that does give them a clean sheet and a clean slate to start from. But all of them are looking at, to meet the omnichannel objective, to eliminate stock push through central management of supply with manufacturer inventory and manufacturer ordering. And this shift to a more dynamic vehicle supply system requires significant change in organization, who does what, skill sets, the skills required to do those different tasks. For example, in a dealership, moving from a salesperson to a consultancy type role with the customer, and people's objectives and targets and mindsets at every level of the auto industry, including manufacturers' European headquarters and at the NSC. And this change process is tough. Manufacturers have a history of reverting back to push, I'm sure you're all aware, but quite a few of them seem to be aware of the challenge and at the top level, the need to stick to the plan from a top level strategic and point of view to make sure it happens, to deploy the policies and practices and make far-reaching decisions. In the US, even, the far more stock push than Europe, where build to order is almost unheard of. Build to order rates have never been as high as they are in Europe at the moment, and the profitability it's delivering for manufacturers has made them think, at least rethink how they would return to the market once supply returns. There's some quotes there that suggest manufacturers might revert to their way of to push and market share obsession and units obsession, but I think there is an awareness that there is the opportunity to do things differently, with greater focus on the retail side of the business, and to allow this to make the most of this situation in terms of supply constraints, and align their current operating model using order banks more carefully to their plans to align their new network strategies to a mixed online offline channel. I'm very aware of constraints of time, and I wonder if there might be some questions, so I will stop sharing now and hand back to Amanda.
That's great, Ben. Thanks very much. Really appreciate that. It was a really insightful presentation. I suppose we don't have a huge amount of time for questions, but I did just have one as sort of chair's prerogative. Obviously, you saw through the respondents' questions to our business impact survey that customers are asking for, a more agile approach to mobility solutions. How do you see what you've just presented there in terms of where the manufacturers are moving to? Do you think that's recognised through their approach? Does that work?
Well, I think, again, if you think about whether it's connected car or online, manufacturers want to get close to the customer, and they want to have that more direct relationship. Mobility is part of that. A lot of the work we've done over the years on mobility, there are lots of weaknesses with quite a few of the mobility models, but I think manufacturers are very focused on moving to more direct customer leasing on the retail side, and that appears as under the label of subscription in many cases. Some of the subscription models clearly don't work, but some of them, just a bundled lease sort of thing that we've had in the UK for quite a long time, even on the retail side, is very much a focus of attention, and also beyond the first life cycle, so second and third usage cycle. And therefore manufacturers are likely, well, several of them are planning to get more involved in the supply process in terms of used vehicles beyond the first cycle. A good example, public domain again, is Renault with their used car remanufacturing plant they've just opened in Paris.
Okay, that's great. Ben, sorry, echo, do apologise. Ben, thank you very much for joining us this morning. That was a really interesting presentation. If we can now bring a face, thanks Ben, now bring a face very familiar to many of you, Dylan Setterfield from CAP HPI. Good morning, thank you for joining us today.
Pleasure.
And
shall we race on?
I was going to say, we will race straight on into your presentation. Thanks, Dylan. I'll hand over to you.
Thank you. Just get the slides up. So yeah, thanks, Amanda. I'm going to cover quickly effects of the various supply issues on new car registrations, some of those discrepancies that we've seen by channel, what that means in terms of supply and demand in terms of used car values. So how supply affected registrations? Well, as you're probably aware, 2021 came in just under 1.65 billion, and that annual total obviously heavily impacted initially by lockdowns and then by those supply issues, which really hit from about August, September onwards. Although the year was slightly up on 2020, it was still 680,000 units, or 27% down on those pre-pandemic levels. Now, our forecast for this year is 1.89 million, which would be a big improvement over 2021, 15% up, but still more than 18% lower than we were back in 2019. Over the total pandemic, we've seen a shortfall of nearly 1.5 million cars compared to 2019 levels, and we know there's a bit more to come in the short term. Those cars, never registered, never went on the road, and therefore are never coming back into the used car market. We still think by the time we get to 2025, we'll be about 2.36 million, but certainly can't envisage getting back to those heady heights that we saw back in 2016. Now, there has been a significant distortion in the new car market in recent months. Manufacturers have clearly been prioritising retail over all forms of fleet. And if you look at Q4 last year, retail was actually only down 1.3% on 2019, just 2,000 units down. But over the same period, SMMT fleet registrations were down 41.3%. Retail down 1.3%, fleet down 41.3%. A fleet shortfall of nearly 116,000 units in what's traditionally quite a quiet quarter. If we look at the longer term situation regarding fleet registrations, and this shows the comparison between the monthly rental and leasing registrations compared to 2019 levels. The yellow line is the SMMT daily rental subclassification, and the green line is the main fleet classification minus the daily rental amounts. So there is a tiny bit of distortion in there from some other minor channels, but unfortunately the sub-classifications aren't really reliable, but this comes out to be a pretty good approximation of the true leasing picture. The red arrows denote the lockdowns with the obvious effects there. You can clearly see that impact, big impact of the first lockdown. You do have to be slightly careful when looking at these percentages, as you can see from that highlighted August data with small volumes. But equally, you can see fleet has been below 2019 levels in every month since a little blip in July 2020. Rental was briefly above 2019 in the second half of 2020. It's been significantly down ever since, apart from again in August. and it's deteriorated to virtual non-existence. The only way is up. February was 93% down on where we were back in 2019. If you look at it in a slightly different way, now we're looking at registration volumes. It's the same classifications, but I've done it by quarter, so it's a bit easier to digest. And obviously Q1 22 is just January and February because we haven't got March numbers yet. But again, you got a very clear signal there of the magnitude of that impact from the first lockdown. But if you look at Q3 and Q4 21, you can see that combined impact of the supply situation on leasing and rental businesses is actually pretty close to what we saw back then when everything had just stopped. I suppose one word of caution, to briefly mention it, but don't interpret that far right-hand side as things having considerably improved. March is a very big month in terms of registrations, and obviously we'll be looking at those numbers very carefully next week when they get published. If you look at that on a cumulative basis, then all of a sudden that first lockdown in 2020 Q2 doesn't look like such a massive impact. If you think back to August, it did look like at the time the semiconductor situation was calming down, but in the space of just 2 weeks, it spiraled back out of control again. So by now, from that total new car shortfall of nearly 1.5 million cars, almost 1 million of those are in rental and leasing, about 2/3 of the total. And remember, we're likely seeing an additional shortfall once March gets completed. The 3-year-old used car market is heavily influenced by the return to leasing contracts. And this is a key part of both the rationale behind our expectation of the market adjustment that we're seeing this year, but also that positivity that we've built into the outer years for reduced car supply. And again, for a bit of perspective, the biggest shortfall in a calendar year on this basis that we saw from the financial crisis 13, 14 years ago was 154,000. And the total fleet shortfall over the entire period was less than we saw in 2020 alone. So in terms of what's happened so far to used car values, from June 2020, obviously the market was strong with the release of pent-up demand, people buying cars to avoid using public transport, and that was one of the major factors that meant that 3-year-old values and older performed better than 1-year-old cars. Early 21, back in another lockdown, market was much slower, and then dealerships reopened from April. And what we saw then was record increases, absolutely massive, driven by really exceptional consumer demand. We have that thing of accidental savers, people who hadn't been going out, hadn't been off on holiday, wanted to splash out and to treat themselves. So sports cars were the first that we saw rocketing in price, but very soon afterwards, pretty much everything else followed, all of the mainstream cars. From a dealer perspective, cars were selling twice as quickly as normal, but you can't just source twice the amount of stock. It's just not possible at the best of times. So there was massive competition for stock. And then just as demand had started to ease off, we had that semiconductor shortage starting to bite and other supply issues around August, September time. And that period of positivity got extended even further. Now, during this period, you can see 1-year-old values have been significantly outperformed by 3-year-old values. And there's a couple of reasons for that in addition to what we've already mentioned. 1-year-olds are clearly higher value cars, so a smaller percentage can result in a much higher pound note value change. And there's also that limiting factor of the cost new and list prices. So we're just past the high point of used car price inflation now. A quick reminder, when I talk about year-over-year percentage deflation or inflation, we're always looking at the same vehicles at the same age and the same mileage, and we measure that percentage increase or decrease in values over a 12-month period. So if that line is coming down, but it's still above 0 on that left-hand y-axis, then values are still increasing, but more slowly than before. And it's only when it goes below 0 on that axis that prices are going down, and vice versa. So as we just saw today, March is up an astonishing 38% at 3 years 60 and 28.5% at 1 year 20 when we compare it to where we were last year. Amanda said to me yesterday that this graph looks a bit scary, so I do need to just explain it carefully for anyone who isn't familiar with it. We will see big reductions in that year-over-year percentage measure this year, because last year's record-breaking increases are not going to be repeated, and they get replaced with greater than average downward movements for most of the rest of this year. By March 23, we expect to be about 15% down from where we are today, and 11.5% at 1 year 20. But importantly, that's still 21% and 17% higher than they were a year ago today, and remaining well above pre-pandemic levels. 1 year old values didn't go up as far. We don't expect them to come back down as far, and we actually expect them to remain a bit better in relative terms than 3 year olds for some time afterwards, partly because of daily rental registrations and other shorter term channels remaining pretty subdued in comparison to what we've seen in terms of historical levels, and really limiting that used car supply. But 1 year old cars have been in short supply for a long time, and even pre-pandemic. Prices then come back above the line and are therefore increasing again by the time we get to Q4 2023. So in summary, rental and leasing have been hit much harder by those supply shortages compared to retail. Manufacturers have made quite understandable prioritization decisions. As we expected, we've seen some slight improvements in the volumes going into fleets over the past couple of months, and we do expect that to continue through the year. But daily rental is a very different situation. Several manufacturers appear to have withdrawn, at least for now. There doesn't seem to be much prospect of volumes increasing in the short term. That first lockdown, was a real shock, and we've then had that followed by the supply issues, driving registrations below normal levels for quite an extended period, with the inevitable effect on future used car supply, particularly at that 3 to 4 year point. And we expect to see that translating into a positive impact on trade values by the time we get to September 2023. So we get a market adjustment this year from that exceptional high point, and then a period of stability early next year. And then we start to see values increasing again as a result of that reduced used car supply. I think that's everything that I had, and hopefully we're still in time. Can we cram a couple of questions in? I don't know.
Hi Dylan, thank you. That was really interesting. And yes, that graph, I think that when I was looking at your presentation yesterday, that graph did look a bit scary, but I think that we had a similar discussion at our residual value and remarketing committee last week. And I think the most important thing is that if it goes down gradually, then we're okay. I think it's more if it's that kind of, we have any kind of cliff edges or sudden, massive drops, that it becomes an issue, isn't it?
Yeah, we don't think it will come down as far or as fast as we saw prices going up last year, because that was just, a very, very unique situation.
Yeah, we did have one question in the comments that we are short on time, but I will just ask it so we get the clarity. Are the registration forecasts already adjusted for the impact of the Ukraine war?
Yeah, slightly. So that forecast of 1.89 million, I think originally we had 1.94, so it's about 50,000 reduction as a result of that. But yeah, much of the Ukraine volume impact is pretty short term on a limited number of models.
Okay, and I'll just sneak one quick one in, which I'm not sure will be you. I'm not sure whether it's your area of expertise, but someone's just asked, are commercial vehicles following the same traits? I know you tend to focus on cars.
It's quite difficult to say, really, because demand for LCVs is so strong. If you look at last year, then the total registrations LCV were very close to 2019 levels. But I think if the supply had been there, they would have been much higher than 2019 levels. So it's quite difficult to say. Early last year as well was very strong. So doing comparisons from this year against last year is also quite tricky. They have been affected. The biggest impact is probably on electric vans, which seem to be very difficult to get hold of.
Yeah, I think we're going to have a little bit of a focus on commercial vehicles and vans at our June RVR forum. So we'll see if we can get maybe get Cap to cover that at the June forum, that would be good. Dylan, thank you very much. That was a really insightful presentation, much appreciated. And thank you as ever for joining us.
Thanks for having me.
While Helen's just busily getting our panel guests online, I'll share the poll results, which we asked: how badly are the current supply shortages impacting your business? And as our, similar to as you would expect, our business impact survey, the majority of people are saying it's tough, it's a challenge, but we're still doing well. So that was 67.3%. So I think quite a positive story to lead into our panel, and I can see everybody is on screen, so that's great. I'm going to rather than sort of doing I'm going to get everybody to do their own biographies, but just quickly, I'm joined by Mark Palmer, Brand Director, Auto Trader, Lee Jones, Managing Director of Fleet Procure, Per Vogel, CEO of United Rental Group, and Paul Lund, Senior Director at Fitch Ratings. So welcome everyone. Good morning.
Good morning.
I'm going to just start by going around the screen and asking everybody to just, if you could introduce yourselves and just give us a sort of brief one line about what the supply challenge means to you at the moment. So if I start to the right of me, that's Per, if you want to go first.
Morning, Amanda. So my name is Per. I represent United Rental Group, and the shortfall in supply is at the moment a real challenge for our network. I've been working with United now for 2 years, and I worked before for 5 years as the MD for Six Rent-A-Car, and I'm looking forward to the discussion today.
Great, thank you. Mark?
Yeah, good morning, everyone. So I'm a brand director at Auto Trader. I do an awful lot of work with our data, and we have done tons of work on the impact of the new car drop, which Dylan just spoke to there, and what impact that's going to have on the used car market, whether it's going to persist in new. Of course, we've seen a big drop off in the availability of new car stock on the platform, and also on used cars, and consequent impact on those increases in pricing. So again, just as the rest of the group, I'm sure interested to talk about what we think the impact of that is going to be on pricing through the coming months and maybe the next year.
Great, thanks. Paul?
Hello, my name is Paul Lund. I'm at Fitch Ratings, and we provide credit ratings for to be used by debt investors in the major car manufacturers, the OEMs, first and second tier auto suppliers, and also companies like Constellation, which owns We Buy Any Car.
Great, thanks. Hi, Paul. Lee?
Good morning, I'm Lee Jones of Fleet Procure. We are a procurement platform that links 30 leasing brokers with over 200 dealers, and we work with a number of OEMs directly as well. The challenges specifically for the leasing broker market we see is going to be cash flow in Q2, lack of deliveries, delayed deliveries. It's a bit of a drain on leasing brokers' time. A lot of the time is normally focused on gaining new orders, new sales. But the challenge is actually changing into trying to protect their order banks and managing that cash flow throughout Q2 before we hopefully start seeing an improvement in Q3 on the supply front.
Yeah, it's interesting times at the moment, isn't it? I think. So welcome everyone. I should have mentioned as well to everybody listening, obviously there's the comments box on the right hand side. Please feel free to put forward questions to the panelists as well. I've got quite a few lined up, but would welcome obviously comments from the audience as well. I'm going to start with Mark, if that's okay, and say the story of 2021 was all about a surging used car market. What do Auto Trader think the story of 2022 will be?
Yeah, so 2021, of course, all about surging used car market. That's a function, of course, of supply, demand, and then the impact on pricing, which the group has seen, and we've seen across all of your members and across the wider industry. Now, what we see at the moment is that supply is still behind. So at a market level, it's behind 5 to 7% over the last few weeks, and that varies between different age cohorts or types of vehicle, sector, fuel type, and so on and so forth. And of course, as we've seen this morning, that's going to continue with the disruption that we're currently seeing. So earlier in the year, we forecast a drop of a third of available supply of 1 to 3 year old cars, and we're seeing that come to bear, of course. But it's also worth knowing maybe that 0 to 1 is currently 40% behind where it was last year. And a year ago, early 2021, that was a 40% drop on 2020. So we're seeing different, and that will then of course filter through into the 1 to 3 year old cohort as we move forward through this year. So that supply drop will definitely be continuing for the foreseeable future. We're talking about a few years potentially in the used car market as cars age, of course. Now, in terms of demand is softening slightly, but again, and this talks to Dylan's point, it's still well ahead of 2020. If we were to consider pre-2020 or pre-pandemic a normal kind of period, we are still far ahead. So whilst at Auto Trader we're sort of seeing audience level off, we're talking about 11 million users a month, whereas pre-pandemic we used to talk about 9 to 10 million. So we're well ahead of what we were used to. It's just not growing as fast. And that brings us on to pricing. And I'd echo what Dylan was talking about just there. Pricing, in the last week, we do a weekly, daily update, but in terms of the week, prices are up 28.3%. Retail prices year on year, 28.3% ahead of 2021. Now that's important because whilst it's leveled off in recent weeks, it's still ahead of 2021. And again, I'd say we need to view this in the context of pre-pandemic, because we used to get excited in the industry and Auto Trader about increases of 1 to 2%. But through 2021 in particular, we hit double figures about the middle of the year. And for the past 6 months, we've been seeing price increases of 20 to 30%. So while supply remains where it is, and it is still behind and is going to be behind, as long as demand holds, and I'm sure we'll come on to talk about demand and what we think is going to happen there, then we see that 2022 will be similar to 21, albeit a little bit softer.
Okay, thank you, Mark. Really interesting to look at. I'm going to come on to Per and Lee, if I can. I think just thinking about the presentation we saw from Ben and what he was saying, and about the direction of travel with the manufacturers. I'm going to ask you both the same question. Obviously, Per from the rental side, but Lee also from the from the leasing broker side. How do you think the manufacturer's approach that Ben spoke about, how does that impact the rental sector? How and how have SME rental companies had to adjust their businesses with these supply challenges?
I think there's a difference, first of all, between van rental companies and car rental companies. So on car rental, these are traditionally the very big players, the enterprises, the Europcars of this world, and they have to battle their own things with cars. But when I look at our membership and our members, they're mostly independent rental companies. They're mostly van rental companies. And the support of the manufacturers throughout 2020 and 2021 was amazing. We had absolute record numbers of vehicles coming into our network. And if I look at the growth of the independents over the last 24 months, it's mainly driven by volume, a little bit by price. But if you looked at the major car rental companies, they're all just driven their growth by price and not by volume. I think 2022 is going to be difficult in terms of supply, but a lot of our members, they ordered literally 20 months in advance, 12 months in advance. So I think they're going to be okay till probably Q3, Q4. What is a concern is the Ukraine. I think actually the Ukraine will impact us much more than we think. I hear difficult stories from OEMs about it, but in the van sector, good supply until now a little bit difficult for the next few months. But I think we need to see how the year pans out.
Okay, that's great. Thank you. And Lee, I think sort of similar question in terms of what, again, as I say, what Ben was presenting. How do you think that impacts in terms of leasing brokers and the impact of the supply shortages and changes in approach? What does it mean for the sector?
The leasing sector is continually growing year on year. So whilst this isn't affecting, we still have to remember that the leasing broker section is just growing every year. So we have growth, and actually supply issues, price increases. Leasing is a way that can actually sustain those sort of changes, because a monthly payment increase is more easily sustained in the market than cash outright increases. So last year, I think most leasing brokers would say it was one of their best years ever. Everyone was reporting great growth. Supply wasn't too bad in the end. It started to bite towards the end of the year, and I think we're all kind of seeing it's gradually getting worse. But leasing brokers will always weather these kind of storms better because we're monthly payment driven, and the leasing brokers are more agile, quicker to react in the market, deal with all brands, all 34 key OEMs. So, if anyone's going to weather the storm as well as anyone in the market, it'd probably be the leasing broker sector because of that agility that they have.
Absolutely. I think that's a really important point. And that word agile's come up again, which I think is just such a key one at the moment, isn't it? You do just have to be agile and be able to work in, switch to what the needs are. Paul, if I can come to you now, people have spoken about the end of the era of stability. We've seen a lot of shocks, and Dylan's graph earlier showed that massive downward curve, which when I first as he mentioned, when I first looked at it yesterday, I was like, oh, that looks terrible. But as most firms prepare for shocks to become more regular, what could this change? How's this impacting in terms of your world?
Well, I think what we've seen for the manufacturers is they're thinking about what happened in 2007, 2008 when they were going for volume and heavy discounts, and they were left with tons of stock at that point, and a lot of them were highly leveraged as well. They had a lot of debt on their balance sheets. Coming into these shocks, the companies have a lot less debt on balance sheets. A lot of them have net cash positions. So in terms of their liquidity and their ability to weather any cash flow effects, then that's that they're in a much better position than they were at the time of the financial crisis. I think what we've seen with, we've had a lot of shocks already. So we've got COVID, and then we've got the semiconductors, which is still ongoing. They're still, trying to build new semiconductor capacity. So there's still going to be a shortage of new car build for some time, and possibly into Q3 this year. But the other question is, what is the response? And I think what the manufacturers are doing is not building the cheaper, lower margin cars. At the moment, they're going for the higher spec, higher end vehicles where they can get a lot more margin. So we're seeing, even though the companies they're generating less revenue, their margins are much better. And we're seeing, car ranges which previously didn't create particularly good margins for the manufacturers are now creating much better margins. And I think what we've seen is a slightly slower investment cycle. So vehicles which were due to come online, last year, 2021, they've been pushed and delayed. So keeping manufacturing existing fleets and existing models and delaying the new rollouts. And I think that's saving some of the cost as well. I mean, just in general, in terms of the cost shock, I mean, Ukraine is coming up as a potential for wiring looms, and I think the manufacturers have sort of played that down a little bit and say we've got alternatives. I think the other element is actually what's happening to the manufacturing supply chain. So how in the past it was very much just in time type of delivery, and I think what's happening now is that at least the first tier suppliers have had to extend their supply chain because of Brexit. They've had to move away from the reliance on the Dover-Calais routes, which were always very, very free, and now they're not. And we're hearing that a lot of parts are now moving via container through other slower docks, but through routes which are much more reliable. So in general, there's a ton more cost now in the supply chain because there's a ton more working capital. On the other hand, the manufacturers have destocked the finished product, so they've really not got much finished product available, and they're about a third of the stock levels they were at the start of the pandemic. So clearly, an awful lot of change.
Yeah, and it's that increased cost again. So I suppose there's so many things that are impacting consumer confidence at the moment, and our residual value and remarketing committee last week, that was a huge point of discussion, is consumer confidence waning. I suppose, Mark, are you seeing anything in terms of the Auto Trader platform? Is there any change in terms of what people are looking, what type of vehicles people are looking at, or any, are you seeing any less interest yet in used cars?
as I said earlier on, audience has kind of stabilized, softened. February was a very, very tricky month because, of course, Auto Trader tends to have, we see big patterns of traffic at the weekend and things like that. But there were things like, there's the usual seasonal stuff like half terms and things. But of course, there were 3 big storms in a week in February, which impacted audience. So it was a little bit difficult, it was volatile. And of course, Ukraine on top of that. So the data for February was a little bit volatile. We've tried to take a sort of a view and maybe a broader view and looked at things like consumer confidence indicators, which we know in the wider market are falling. So that the GfK consumer confidence score now is at its lowest level since January 2021. But as far as activity on the platform goes, as I said, audience and visits to the platform are pretty stable, softened slightly. But we're still seeing, high levels of inquiries to retailers. So at the moment, no real signals of alarm, although we're not seeing the growth that we were seeing over the last couple of years, and we're still, as I mentioned, ahead of pre-pandemic levels. As to whether or not those, the mix of vehicles that people are looking at is any different, again, that's quite a complicated picture because they can only look at the cars that are there. And we have seen that huge change over the last couple of years in availability of certain age cohorts and types of models. As Paul has just spoken to there, manufacturers have built the cars that have been most profitable. Those are now filtering through to the used car market. So there's quite a lot of change. But I would say in terms of confidence, we're not yet seeing a big drop. The surveys that we run ourselves, people are saying they're confident that they can afford the car that they want to buy. We've still got 40 to 50% of them planning to buy a car within the next 3 months. So are in market, still pressing ahead, and we're not yet seeing any sharp declines in people beginning the research process of buying a car.
Okay, that's kind of reassuring, I guess. Thanks, Mark. Per, if I can move to you, lots of the comments from our business impact survey showed customers are looking for more flexible, agile solutions. Is that a plus? I see that as a plus for SME companies, but obviously you're closer to it than me. What's your view?
I think the one on the results that you had before in your survey was that flexible van hire was the top demanded product in terms of rental. And we can see this throughout our network. It's Lee was mentioning before that a lot of people in his industry had a really good 2021, and we can absolutely echo this. I was a few weeks ago at a regional meeting with our licensees in Cambridge. We had probably 40 people from East Anglia there, and everybody in the room had their best ever 2021. And that's driven by flexible van rental solution. That's driven by the demand for that. So I think rental will, especially in a time of crisis, be a very interesting product in the market. We've got to find the right mix on one side between the supply and the product. I think what's getting more difficult at the moment is holding periods are extending because of some of the supply issues, people keeping vehicles longer on rent and maintaining them longer. But I think all in all, it's definitely a growth market for us.
Great. We've just got a question from the audience. I'm going to go back to Mark, if that's okay. Still doubt in terms of EV residual values. What numbers are you seeing in regards to searches for used EV vehicles?
Yeah, I'm glad you asked that actually, because there has been a change in activity around EV, and it's linked to the question you just asked me around affordability and whether or not we're seeing patterns of change. The one big thing which is happening over the last month has, with the increase in fuel prices, has been an upturn in EV interest, and that plays out in both new and used. So we've seen, we saw this last September in new, where about a quarter of all views of new cars on the platform were for an electric car. So it went from about 15 to 16% over the course of a week to 25%, and that was on new cars. We saw a blip on used, where there were more views and more inquiries, but the relative number of stock on the platform was only at about 2%, so it's quite small. Now, what has changed this time round is a huge increase in the volume of leads or inquiries to retailers and views of used electric cars. So to give you a sense of the order of that, ordinarily on cars that are kind of 0 to 5 years old, all cars, EVs, would take a few percentage points of interest, and they were running at kind of about 2 to 3% of inquiries sent to retailers. In the last few weeks, the lead share of EVs has gone from 3% to 6.5%. So we've seen a really big increase in interest, not just in new, which we would have expected anyway, but this time in used, and that bodes pretty well for forecast values. I guess one other thing I'd say, the stock levels are pretty small, but we're talking about some quite chunky increases in the kind of activity that people are seeing. And we are also, I would say, just one other thing, just to close on that, what does that mean for kind of volume and premium and so on and so forth? At the moment, we're seeing on premium electric cars, demand is up year on year, 70%. And on volume premium cars, it's 97%, it's doubled. So big increases, and this is on used, big increases in sensitivity to fuel and what that means for used.
Great. Thanks, Mark. I think we're rapidly going to run out of time, but I think there seems to be certainly we'd really be interested in all of your views. So I'm going to ask you all the same question, which is around when you see the supply situation improving. And I'm not obviously expecting you to have a crystal ball, and I won't hold you won't be held to account for any of the answers. But if you could all just sort of comment about when you see the supply situation improving, that would be good. Per, if we start with you.
I think it really depends on OEM to OEM, and I'm not going to mention any, but I think we will have some players in the market which have more supply probably by the end of the year. We have others who are really struggling significantly more. But like you explained, it's a crystal ball. 12 months ago, we were in a lockdown and nobody expected that. So, but I think it's going to be a pattern, easing supply first by the end of the year and then more in 2023.
Great, thanks. Mark, any differing views on that?
One thing to add, I completely agree, we'll be into 2023. The thing is that across, the manufacturers are prioritising certain cars to build, aren't they? And a lot of those are electric. What we're seeing is order banks are full until the back end of this year. So whilst cars are being built, they're fulfilling orders that the manufacturers are taking right now. So you would, in terms of free supply, the days when you can kind of go, right, I got to choose between a bunch of different cars and stock and availability, I think that is well into 2023, because the cars that they're going to build between now and then, assuming things start to return to normal, are going to be taken up by existing orders from many manufacturers.
Paul, I guess same question, and so going back to the one that I posted yesterday, if we ran this webinar again in 6 months' time, what do you think would have changed, if anything?
I think we'd have a crystallization of the pricing policies of the OEMs. I think what we're seeing at the moment is that the OEMs have pricing power for the first time in a long time, and that's why that's led to complete reduction in discounting for fleets in particular. What we're seeing is that the OEMs are trying to keep a hold of the car for the whole life now, and include that in their own leasing activities. And we've seen Stellantis, which owns Peugeot and Fiat Chrysler, basically setting up their own bank now, similar to Mercedes-Benz, similar to Volkswagen. They're really looking at the financing side of things in order to keep control of a vehicle for the entire life. In terms of the keeping control, I think also the OEMs have said, or some of the OEMs have said, we need to bridge the margin gap from EV to conventional fuel. So that's suggesting to me they're still struggling with margin on EV. EVs are very expensive to make. They're very expensive anyway to buy. So, the question is going to be, are they going to continue to restrict supply? Are they, they're going to have to continue to work on the supply chain and get costs down across the board for all of the factors that go into EVs, and get up to the levels of volume which make them, give them a much better margin. So I don't see necessarily, I hear the pent up demand, but I don't necessarily see the volumes of EV coming up as quickly as the demand's going to suggest, because of the prioritization of margin for the manufacturers.
Okay, that's great. Thank you, Paul. And final words with you, Lee. What's your view? When are we over this, I guess? Oh, sorry, Lee, you're on mute.
There we are. So yeah, just saying, crystal ball, definitely. If you asked me 6 weeks ago, the noises I were getting were sort of July onwards, we would see an improvement, and even talks of some of the EV order banks that they're quoting 2023. They said that they would actually start moving into 2022 as the semiconductors became available again. I think the issue you've got with order banks at the moment is they are delaying key EVs purely over the material costs. They cannot afford to sell those vehicles at the prices today, despite we've seen some manufacturers 5 price increases in the space of 3 months. The price increases are not keeping in line with the raw material cost increases. You know, steel nearly doubling, nickel nearly doubling. There's massive price pressure out there. There's supply issues, and it's not just the motor trade that's buying these materials. Oil and gas industry. So now all of a sudden there's a ramping up of oil and gas needed, exploration, pipelines, because of the whole Russia crisis. They need those raw materials, and they will pay more money because of government subsidies. So there's a lot of other underlying issues that are not being potentially seen at the moment. I think the key for us is the moment Ukraine crisis can end, we could start seeing things change, because I think they're pushing supply deliberately because they cannot afford to supply at the prices that those orders have been taken at. That's just the reality of it. I think see those wholesale prices come down, and like magic, production dates will start being released out of nowhere, which we often see in the motor trade is that, for, you don't hear anything for 6 months, and all of a sudden the vehicle's arriving, and they've just pulled it from another pot. That's all it is. So right now, I think we have to look September onwards is kind of where I see a lot of the supply coming through. But again, question marks, whether it's lockdowns in China again, Ukraine crisis, raw materials, see an improvement there, and it might come forward a bit. But reality is right now, we're looking September onwards, and a lot of the key EV vehicles, they're pushing into 2023.
That's great. Right. We are dangerously close at running over, so I'm going to have to call it to a halt there. I would be happy to spend the next 30 minutes talking to all of you. I think it's been really interesting. Thank you so much for taking part in the panel. Really, really appreciate your time, and for giving us some really good insights today. So thanks, everybody. Thanks to our earlier presenters as well. Ben from ICDP and Dylan from CAP. Really interesting to hear your views and thoughts as well. It just leaves me to say thanks to all of you for joining us today on our webinar. Hopefully we provide you with some useful insight and some things to think about. I think the overall message I would take away from today was that we're okay, but there's some bumps along the road. I think that's probably as good as I can summarize it, and let's just hope that things start to even out a bit soon. I would draw your attention to our next Industry Outlook webinar, which is taking place on the 26th of May. It's a spotlight on consumer duty, so we're going to get hopefully some experts from the legal background, and we're going to try and get the FCA to come along and just talk about the new approach on consumer duty, what that looks like, and where it's going. So if you want to keep an eye out for that through our weekly updates. We will also publish a feedback form shortly after the webinar. We would really appreciate your feedback. It's really good to make sure that we provide you with what you need to hear about at the moment. Give us new topics that you want us to cover, and speaker suggestions or ideas, anything like that. We'd really appreciate hearing from you. So thank you very much, everybody, for joining, and enjoy the rest of your day.